There's a retirement system that has convinced 60 million Americans to hand over $7.4 trillion of their life savings. It promises security, tax advantages, and a comfortable retirement, but it was never designed to protect your money during a market crash. It was designed to protect someone else's. The 401k system isn't a retirement plan. It's a wealth transfer mechanism, and every major crash has proven it. 2000, 2008, 2020. Each time, regular Americans lost trillions while the system's architects got richer. Not by accident, by design. Right now, as we head into the most dangerous financial period in decades, 401k accounts are loaded with more risk than ever before. The same patterns that destroyed retirement savings in every previous crash are setting up again. But this time, the crash will be different. This time, there might not be a recovery. This is the story of how your 401k was designed to fail, why the next crash will be worse than anything we've seen, and what you can do before it's too late. There was a time when American workers didn't worry about retirement. You worked for 30 years, you got a pension, you lived comfortably. The company took care of everything. You earned it, they guaranteed it, and the math worked for everyone. That system is dead, and it didn't die by accident. In 1978, Congress passed the Revenue Act. Buried in Section 401k was a tiny tax provision meant to let executives defer compensation. It was never intended to replace pensions. It was a tax shelter for the wealthy. But corporate America saw something else, an opportunity to transfer trillions in retirement obligations from company balance sheets to employee paychecks. What happened next was the greatest wealth transfer in American history, not through conquest, not through revolution, through accounting. Companies started freezing pension plans. They called it modernization. They told workers that 401ks offered more control, more flexibility, better returns. What they didn't mention was more risk, more fees, and no guarantees. In 1980, 83% of private sector workers had defined benefit pensions, guaranteed income for life. By 2020, that number had collapsed to 15%. Meanwhile, 401k participation exploded from 0 to 60 million Americans. 60 million people convinced to gamble their retirement on Wall Street instead of receiving guaranteed payments. Think about what that means. Your grandfather worked for Ford. He got a Ford pension, $2,000 a month, every month until he died. Guaranteed. Backed by the company, insured by the government. You work for a modern corporation, you get a 401k match. Maybe 3% if you're lucky. The rest is up to you, the market, and 30 years of hoping nothing goes wrong. This wasn't evolution. This was calculated transfer of risk from entities that could manage it to individuals who cannot. Corporations eliminated guaranteed obligations worth trillions. They shifted market risk, longevity risk, and inflation risk to employees while keeping the profits. Workers got sold on ownership and control while losing security and predictability. The great retirement lie is simple. They convinced you that uncertainty was freedom, that risk was opportunity, that giving up guarantees for gambling was progress. And now, as the largest generation in history approaches retirement with nothing but 401k accounts loaded with overvalued stocks and bonds, we're about to discover what that lie really costs. Follow the money. That's how you understand any system. And when you follow the money in 401k plans, it doesn't flow to retirees. It flows to Wall Street. $7.4 trillion in 401k assets, and every single dollar generates fees. Not for you, for them. Here's how the machine works. You contribute $1,000 to your 401k. Before that money even gets invested, administrative fees take their cut. Plan management fees, record-keeping fees, compliance fees. Then comes the real extraction. Your money gets funneled into managed mutual funds with expense ratios averaging 1.03% annually. 1% doesn't sound like much. Over 30 years, it's devastating. A worker contributing $5,000 annually for 3 decades should retire with $668,000 at 7% returns. But after fees, that becomes $497,000. $171,000 extracted by the financial industry. That's not management, that's theft. But the fee extraction goes deeper. Trading costs inside the funds. Marketing fees disguised as 12b1 charges. Sales loads that immediately reduce your contributions. Hidden expenses that don't appear on statements, but compound against your returns every single day for decades. Meanwhile, your company's human resources department gets kickbacks. revenue-sharing agreements with fund companies. The worse the funds perform for employees, the better the kickbacks for employers. Your employer literally profits by steering your retirement money into underperforming, high-fee investments. The financial advisors pushing these plans get rich too. Commissions on fund sales, annual management fees, financial planning charges. They're not working for your retirement. They're working for recurring revenue streams generated by your contributions. The longer your money stays in the system, the more they extract. And here's the beautiful part for Wall Street. Traditional investments, you can withdraw your money anytime. 401ks lock up your money until you're 59 and a half. Guaranteed captive assets. Guaranteed fee extraction. For decades. The 401k industry generates over $100 billion in annual fees. Money that comes directly from worker contributions and returns. Money that should be compounding for retirement but instead funds Wall Street bonuses, corporate jets, and Manhattan penthouses. You're not the customer in this system. You're the product. Your contributions feed a trillion-dollar industry built on extracting wealth from American workers while promising them security they'll never receive. March 2000 marked the beginning of the dot-com crash. What happened next revealed exactly how 401k plans respond to market collapse. It wasn't pretty, and it established the blueprint for every crash since. The Nasdaq peaked at 5,048 in March. By October 2002, it had fallen to 1,114, a 78% collapse. But 401k accounts didn't just fall with the market, they fell harder. The average 401k lost 25% of its value in the first 2 years. Money that workers had saved for decades, gone. Here's why 401k accounts amplified the losses. Most plans offered limited investment options. Technology-heavy funds, growth funds, large cap funds, all correlated, all falling together. Diversification was an illusion. When tech crashed, everything crashed. But the real devastation came from the forced participation structure. Workers were locked into automatic contributions during the collapse. Every paycheck, more money flowed into falling markets. Dollar cost averaging, they called it. Catching a falling knife is what it actually was. Systematic buying during systematic collapse. Meanwhile, corporate insiders who understood what was coming had already sold. Enron executives sold $658 million in stock while telling employees to keep buying in their 401k plans. WorldCom insiders sold over $12 billion while worker accounts got destroyed. The pattern was consistent across every major collapse. Insiders out, employees in. And here's the cruelest part. The buy and hold strategy that 401k plans forced on workers guaranteed maximum losses. Professional investors cut losses quickly. 401k participants were told to stay the course, keep contributing, trust the long term. They rode every stock down to the bottom. The recovery story you hear is mostly mythology. Yes, markets eventually recovered, but individual 401k accounts often didn't. Workers near retirement had no time to wait for recovery. They retired with devastated accounts. Younger workers who panicked and moved to cash missed the eventual rebound. The system punished both staying and leaving. By the time the dust settled, trillions in 401k wealth had vanished. Not temporarily, permanently. Money that should have funded retirements instead funded Wall Street bonuses during the crash. Because even in collapse, the fee extraction continued. Every transaction, every rebalancing, every desperate move generated revenue for the managers while destroying wealth for the workers. The 2000 crash wasn't a market correction. It was the first proof that 401k plans amplify losses during crisis while protecting no one except the people collecting fees. The 2008 financial crisis didn't just crash markets. It exposed the 401k system for what it really is. A mechanism designed to concentrate losses on workers while protecting the institutions that created the crisis. And the numbers tell the story. Between October 2007 and March 2009, 401k accounts lost $2.4 trillion. Not million, trillion. In 15 months, American workers saw decades of retirement savings evaporate. The average account balance fell from $60,000 to $46,000, but averages hide the real devastation. Workers in their 50s and 60s got destroyed. People 5 years from retirement watched their accounts lose 40% of their value with no time to recover. A 58-year-old with $300,000 in their 401k saw it become 180,000 overnight. 20 years of contributions and compound growth gone. These weren't speculators or day traders. These were teachers, engineers, nurses who followed every rule and trusted the system. Meanwhile, the banks that caused the crisis got bailed out. $700 billion in taxpayer funds to rescue the same institutions that had packaged toxic mortgages, and crashed the global economy. But 401k participants? They got nothing. No bailouts, no rescue packages, no government intervention, just devastating losses and advice to keep contributing. Here's the cruelest mechanism of all. As markets crashed, 401k plans forced systematic buying through automatic contributions. Every paycheck, more money flowed into collapsing assets. Workers were literally required to buy high and sell low. The professional money managers running pension funds could move to cash, reduce risk, preserve capital. 401k participants had no such flexibility. The age discrimination was systematic. Younger workers had decades to recover from losses. Older workers had years or months. The system that promised security delivered catastrophe precisely when people needed stability most. And because 401k balances determine retirement lifestyle, these losses meant permanent reductions in living standards. Even worse, many workers were forced to take early distributions during the crisis. Job losses, medical emergencies, home foreclosures. They had to raid retirement accounts at the worst possible time, locking in massive losses while paying penalties and taxes. Desperation selling at market bottoms, while the wealthy bought assets at fire sale prices. The 2008 crisis proved that 401k plans aren't retirement security. They're systemic wealth transfer from workers to Wall Street. When crisis hits, banks get bailouts and workers get wiped out. That's not a bug in the system. That's the feature. March 2020 brought something new. A crisis that crashed markets in weeks, not years. The S&P 500 fell 34% in 33 days. But this time, the government response revealed exactly how the 401k system really works. And it wasn't designed to protect your retirement. The CARES Act, passed in March, promised relief for American workers. What it actually delivered was systematic looting of retirement accounts. The law allowed penalty-free withdrawals from 401k plans for anyone affected by COVID. No more 10% early withdrawal penalty, just access to your retirement money when you were desperate. 25 million Americans took early distributions, not because they wanted to, because they had to. Job losses, medical bills, mortgage payments, basic survival. They raided their retirement accounts at market lows, selling devastated positions to pay for immediate needs. The wealthy bought assets at fire sale prices, while workers sold retirement security for grocery money. But the real theft was more subtle. Corporations used the crisis to suspend 401k matching contributions. Companies that had record profits in 2021 stopped matching employee contributions. Microsoft, Amazon, dozens of major corporations. They claimed uncertainty, temporary measures, pandemic response. The matches never fully returned. Meanwhile, the Federal Reserve printed more money in 2020 than in the previous century combined. $4 trillion created from nothing. This wasn't economic stimulus. This was asset price inflation that made the rich richer while destroying the purchasing power of anyone holding cash or fixed income investments. The market recovery that followed wasn't recovery. It was monetary debasement. Stock prices rose because dollars became worth less. Real purchasing power declined even as 401k balances hit record highs. Workers thought they were getting richer while their money was being systematically devalued. And here's the setup for disaster. The 2020 crash and recovery convinced millions of Americans that 401k investing was safe, that crashes recover quickly, that the government will always intervene to protect markets. They loaded up on stocks at inflated prices, increased contributions, borrowed against their accounts, maximum exposure right before the biggest crash in history. The 2020 crisis wasn't solved. It was postponed. The money printing that created artificial recovery also created the conditions for currency collapse. And when that collapse comes, 401k accounts loaded with overvalued paper assets will be ground zero for the destruction. The system used crisis as cover to position workers for maximum losses in the crash that's coming next. Right now, in late 2025, every condition that creates retirement catastrophe is converging simultaneously. 401k accounts hold a record $7.4 trillion. Baby boomers are retiring at 10,000 people per day. Federal debt exceeds $36 trillion, and inflation is destroying purchasing power faster than investment returns can replace it. This isn't just another market cycle. This is a perfect storm that will make previous crashes look like minor corrections, because this time the mathematics of empire collapse are combining with the largest retirement wave in American history. And 401k accounts are positioned for maximum destruction. Start with the numbers. Average 401k balance is $130,000. Sounds substantial until you realize that generates about $5,000 annually in retirement income. Meanwhile, Social Security replacement rates are falling, Medicare costs are exploding, and real inflation in food, housing, and healthcare runs far above official statistics. But the real danger is forced selling pressure. 76 million baby boomers are moving from the accumulation phase to the distribution phase. Instead of contributing to 401k accounts, they're withdrawing. Required minimum distributions kick in at 73. Systematic selling pressure just as markets face their biggest challenges in decades. And what challenges they are. Federal debt that cannot be repaid at any realistic interest rate. A currency losing reserve status as BRICS nations build alternatives. Corporate debt levels that make 2008 look conservative. Commercial real estate collapse that's destroying regional bank balance sheets. Supply chain disruption that's permanent, not temporary. Meanwhile, 401k accounts are loaded with the riskiest assets at the worst possible time. Target date funds automatically shifted workers into bonds just as interest rate increases destroyed bond values. Index funds concentrated holdings in a handful of overvalued technology companies. International diversification disappeared as correlations hit historic highs. The Federal Reserve is trapped, raising rates to fight inflation, crashes asset prices, and destroys 401k balances. Cutting rates to support markets accelerates inflation and destroys purchasing power. There's no policy response that protects retirement savings because the entire system is built on contradictions that cannot be resolved. And here's the final piece. Previous crashes had recovery because America had room to cut rates, expand debt, print money. Today, rates are already near zero. Debt is already unpayable, and money printing is already causing inflation. The tools that enabled recovery from 2000 and 2008 are either exhausted or counterproductive. The perfect storm isn't coming. It's here. And 60 million Americans with 401k accounts are about to discover what happens when an unstable retirement system meets unstoppable economic forces. The next crash will be different, not because markets behave differently, but because the foundation of the entire system is crumbling. Previous crashes were cyclical corrections. This will be structural collapse. And 401k accounts will be ground zero. Here's what makes this crash unique. In 2000 and 2008, the Federal Reserve could cut interest rates to zero and print money without consequences. Today, interest rates are already near zero, and money printing causes immediate inflation. The monetary tools that enabled recovery are either exhausted or counterproductive. Federal debt exceeds 100% of GDP with no path to repayment. Social Security and Medicare face insolvency within a decade. State and local pension systems are underfunded by trillions. The government backstops that caught previous crashes are themselves on the verge of bankruptcy. But the real catastrophe will be currency collapse. The dollar's reserve currency status is ending. China, Russia, India, Brazil, and dozens of other nations are building payment systems that bypass the dollar entirely. When global demand for dollars collapses, hyperinflation becomes inevitable, and hyperinflation destroys everything priced in dollars, including your 401k. Think about what hyperinflation means for retirement accounts. The Weimar Republic, Zimbabwe, Venezuela, Argentina. In every hyperinflation, paper assets become worthless, while real assets preserve wealth. Your 401k is entirely denominated in paper assets. Stocks, bonds, mutual funds, all priced in a currency that's losing purchasing power by the day. The retirement crisis will overwhelm government resources. 76 million baby boomers retiring with inadequate savings. Social Security payments that don't cover basic living costs. Medicare that doesn't cover long-term care. 401k balances that can't generate sufficient income even before considering inflation. This creates a demographic disaster that cannot be solved politically. Younger generations already struggling with student debt, housing costs, and stagnant wages will be asked to support the largest elderly population in history. The social contract breaks down when the math doesn't work. And here's the final horror. Previous crashes had recoveries because America was still growing, still innovating, still expanding. Today, the empire is in decline, infrastructure crumbling, education failing, manufacturing outsourced. The economic growth that powered previous recoveries no longer exists. When this crash comes, there might not be a recovery. Not a quick one, not a complete one, possibly not any recovery within the lifetime of current retirees. The 401k system was designed for a growing economy with stable currency. In a declining empire with collapsing money, it becomes a wealth destruction machine. And 60 million Americans are about to learn that lesson the hard way. The system is rigged, but you're not powerless. While 60 million Americans sleepwalk toward retirement catastrophe, you can take action now to protect your wealth, not through the 401k system, around it. First, understand what survives currency collapse, not paper assets, real assets. Physical gold and silver have preserved wealth through every currency crisis in history. The Roman denarius collapsed, gold held value. The German mark became worthless, gold bought bread. The Venezuelan bolivar imploded, gold saved lives. Real money survives when fake money fails. But precious metals are just the beginning. Real estate, especially agricultural land, maintains value during inflation. Productive assets that generate income in any currency. Energy infrastructure, water rights, mineral deposits, things people need regardless of what paper money does. The challenge is getting money out of 401k accounts to buy real assets. The system makes this difficult by design, but there are strategies. In-service withdrawals if your plan allows them. Loans against your balance that you don't repay. Job changes that trigger rollover opportunities. For younger workers, stop contributing beyond any company match. That match is free money. Take it. But additional contributions are just feeding the wealth extraction machine. Direct those dollars toward assets the system can't confiscate or devalue. International diversification means more than foreign stocks in your 401k. It means assets outside dollar-denominated systems entirely. Swiss bank accounts, Singapore precious metals storage, Canadian real estate. Geographic diversification that protects against single-country collapse. Cryptocurrency offers another escape route, but choose carefully. Bitcoin has proven its value during currency crises. Ethereum has utility beyond speculation, but avoid the altcoin casino. In currency collapse, only the most established digital assets survive. Most importantly, develop multiple income streams that don't depend on paper asset performance. Skills that generate income regardless of economic conditions. Food production, energy generation, essential services. When paper wealth evaporates, real productivity maintains value. The window for action is closing. Every day the system becomes more unstable. Every paycheck contributed to 401k accounts is another dollar at risk. Every month of inaction is another month closer to the collapse that's coming. You cannot stop the system from failing, but you can refuse to fail with it. The choice is yours, but the time to choose is now, before the 401k system completes its designed purpose of transferring your life savings to the people who created the crisis in the first place. History rewards those who see patterns and act accordingly. The pattern is clear. The action required is obvious. The only question is whether you'll take it before it's too late.